as the world economy continues to cross the threshold from growth to contraction, from greed to fear, from stability to chaos. Investors are moving in unprecedented numbers to be liberated from the confines of their economy to trade in the continual bull market, the foreign exchange or Forex marketplace. This is the largest market in the world and the most liquid by far. From $3 to $5 trillion is traded each day in the currency market. That's more than all of the world's stock markets combined. In the foreign exchange marketplace, you are essentially investing in money itself. Not stocks or bonds, but actual currency. So you don't have to stay up nights worrying about a recession or a bear market in stocks or rising oil prices. In fact, surging oil prices might give you a clear signal that the dollar is either getting ready to fall or is falling. When you're trading currencies, you're exchanging one form of money for another form of money. You're selling one currency and buying another. No matter how dismal things get in the stock market, no matter how perilous the bond market gets, if you're looking for something that's going up, you never have to look any further than the currency market, because there is always a bull market in currencies. There is a famous story of George Soros and his trader Stanley Druckenmiller teaming up to break the British pound. It was a monumental time in currencies. Even though he was well-funded, it was still like a David and Goliath story because he was going up against a major central bank. You know, the one that used to be the world's reserve currency before the United States was bestowed that honor. It was said that Soros still made $1 billion on that trade alone. Both he and Druckenmiller are in the list of the Forbes 400 richest Americans still to this day. Don't laugh. This could be you one day. Now let's take a look at some people who aren't as famous in the mainstream standards, but yet are regular people who made fortunes in the currency marketplace. Marcelino Levian has returned 80% over 4 years, yet many don't know his name. He's an everyday family guy that spends about 4 hours a day in the Forex market. He didn't come from a family of traders. In fact, no one had been a trader in his family before him. He started trading around 1993, back when a gap between a buy and a sell quote was a whopping 18 to 22 pips. We'll define these terms in the program. So the trading costs were huge back then. Even still, he became very successful. Good news is those trading pips are now only 1 to 5. He is a fundamental trader that takes longer-term positions on 50 to 1 leverage. He usually in trades for months, long enough for the fundamentals to work themselves out in the economy that he's trading. He assesses the general economy, the political events, and any macro world risks that he sees out there. He always trades on the side of a pair to where he can earn interest, which we'll also discuss during the program. He scales into his positions little by little, leaving lots of cash to spare for wiggle room for his trades while they work themselves out into profitability by appreciating in value or earning interest. He's built up his war chest, enough to where his wife now owns a string of 35 beauty salons and they have an import business from China together. So you've seen a famous trader like Soros that made bold bets against a central bank and literally became a billionaire from it. You've seen a regular Joe that is not famous yet make tons of money taking longer-term fundamental base positions in the currency market. Now let's take a look at a technical trader that uses charts and graphs and indicators to make his fortune. His name is Rob Booker. He didn't come from a trading background either. No one in his family was a trader. If anything, he says he would have been discouraged from trading by his family. He says he's not even that great at math and he's never even traded a stock. However, he learned a knack for back-testing his technical strategies to see if they worked well in the past. Then if they did, he would use very disciplined risk management in order to bring about profitable trading. He says that he doesn't risk more than 1% on any one trade. You know, Rob started out with $2,500 in his trading account. Now he's got traders around the world that follow him while he trades along with one of the major banks of the world. So you can see that there are many ways to climb the mountain of success in Forex trading. Some will strictly use fundamentals, others technicals, while others use a combination of these approaches. You know, a couple other amazing stories. Even people who just bought the currency shares Japanese yen trust, the FXY, made 27% during the worst of the credit crisis and stock crash in 2008. Another, Those who saw the sovereign debt crisis coming in Europe could have made up to 33% in under 6 months, simply shorting the euro right through your stock account on EUO, the ProShares Ultra Short Euro ETF, not even with a Forex account or an options account. In the Roadmap to Currency Riches, a complete Forex mastery course, we will guide you through understanding the currency basics, a short history of how the market arrived at fiat currencies, global economic fundamentals, technical analysis, and the instruments you use to get you started in trading and making profits in this very opportune market. Whether you're just starting out or already making trades, the Roadmap to Currency Riches, a complete Forex mastery course, is designed to make anyone a more informed and better trader. Broken into key instrument modules, your opportunity is to use this program to improve your knowledge of the market, understand what trading instruments are best for you and your risk tolerance, make better trades, and protect yourself from the volatile roller coaster ride of the stock and bond markets. Welcome to the Roadmap to Currency Riches, a complete Forex mastery course. Before we move on, I've assembled our team of experts, or gurus as they're called in the industry, to kind of share with you a little bit about their experience, where they've come from in life, how they got to where they are, and even tell you a little bit about what they're doing currently in their careers and how they're going to help us in this program. So if we can just move on, I'm going to go around the table from my left to my right. Barry, you are from the NASDAQ. It's a very important role. You are a very senior guest here with us. Could you kind of tell us a little bit about yourself?
I traded. I was a member of the Philly Exchange,
right.
And we traded equities and equity options. And we did that in sector index options.
Okay.
Did that for some time. Previous to that, we traded bonds and bond futures,
okay.
And bonds on the interbank market. And we took that, and my brother and I were partners in a firm.
Oh, really?
On the Philadelphia Exchange, and it was my brother and I against the world. It was fabulous. We took our bonus money, our bar mitzvah money, and our paper route money, put it together, and created a partnership on the exchange. And things worked out really, really well for a long time. I was tapped on the shoulder by the vice chairman asking if I can help and assist in the direction of the marketing department at the Philadelphia Exchange.
Really?
To direct the marketing effort at the Philadelphia Exchange. Well, after refusing him, 3 times, my brother convinced me to please to join because it was a payback. He said, we've been successful. This is a payback.
Sure.
And I agreed to help them for 6 months.
Okay. And how long has it been?
10 years.
Okay. Well, that worked out pretty well for you.
It has worked out really well for me. I mean, it's been a really interesting temp job for me. What has happened is through this transition, we were the Philadelphia Exchange. We were bought by the NASDAQ Exchange.
Right.
And NASDAQ put us in, myself, and I consider them my partners, senior staff that works within the NASDAQ Exchange, managing both the Philadelphia Options Exchange and a new electronic exchange, which is the NASDAQ Options Market. We manage both exchanges. What I do for the exchange is I direct the product marketing, education.
Okay.
What we do is I work with a team that we develop strategy, pricing, rules that'll make both of our exchanges competitive against the other exchanges. NASDAQ really has a hands-off policy. I report to the president, which is it's a great thing, and understand and develop different products within the NASDAQ Exchange. We do have equity options. We have sector indexes. And something that we have is our world currency options. And we look at them. We've looked at the product grow. We've made it as easy as possible for a retail customer to be able to use it using the regular trading account, and put a lot of time and effort into making it accessible to everyone.
Well, it sounds like you have an enormous amount of experience. I'm looking forward to working with you all throughout this program as we take this adventure. And thank you for taking the time out to work with our customers and our students in this program. It's great to have you here.
Thank you.
Evaldo, can you tell us a little bit about your background? You're actually one of the only ones of us that is actually an international to start with. So you probably have a lot to share with us on where you come.
Sure. Yeah, my first experience in the financial market, I had my first experience when I was in grad school. I was studying finance. So, but I was not sure what I wanted to do with my education. So I started working in an investment banking firm in Miami, mostly analyzing mergers and acquisition deals. But it was okay for me, but it wasn't really what I wanted to do.
Okay.
So I decided to look for something else. So I started working for a big Brazilian bank out of Miami as well in private wealth management,
Okay.
where I had a chance to work with financial analysts and giving advice to clients in Latin America and in Brazil.
Okay.
And I was mostly working with stocks and bonds, but I had my first exposure to currencies when I was working at the bank, and I just fell in love with currencies. So being from Brazil, I've always had a special interest in assets from emerging markets. So I decided to focus on emerging market currencies, and that's what I do today. Today, I only trade currencies from the emerging markets like South African rand, Hungarian forint, Mexican peso, among others. And that's what I do today.
That's an unusual skill, and I've heard that you're very good at it. So welcome to our program, and we look forward, as I said, to working with you as we move through the modules. Kat, tell us a little bit about your background.
Well, in general, I have been really fortunate.
Okay.
I started off my career in publishing, and I geared more towards the financial publishing world. And for the last 5 years, I have met people from all around the world. I have Swiss banker friends. I have Danish banker friends. I know asset managers all over the world. And in speaking to all of them are masters in currencies. And slowly but surely, we started to write more about currencies and currencies trading, currency investing, and very slowly, I started to pick out my own little niche, which is long-term currency investment solutions.
Okay, so long-term, great.
Long-term. And why I love the long-term is because most people just have no idea about this market. They don't know it exists. And because so many people are 100% dollar denominated, it's very interesting for me to be able to convey these solutions to them.
Especially in that space. So long-term usually means lower risk, too.
Absolutely. And that's exactly what I specifically write about. That's my little niche. And within the currency world, I write and edit a daily newsletter. I write a monthly. So specifically, my focus is the written word about currencies.
That's terrific, terrific. And I'm sure our viewers are going to be very interested in it because it is a great way to get started in the lower risk space. That leaves you, Sean. Sean, you're going to be working with us quite a bit throughout the program. Could you tell a little about your background?
Yeah, I've had almost 20 years now in the financial markets. Started in my early 20s. Basically, my incentive to learn about the financial markets was I was poor growing up. And so I figured I better learn something about money if I was ever going to have any money.
Right.
And a lot of my family was, very, very nice, sweet people, but they didn't know much about money either. And so it really started with my pursuit of learning about how money worked, how finance worked, how money flowed around the world. And so I started off small in my early 20s with stocks and mutual funds and things of that sort. Then went into the brokerage industry, became a stockbroker, later on a manager of a team of stockbrokers for a major firm here in the U.S., and loved that. I mean, it was just like a newfound love. And just when I thought I wouldn't like anything better, I also stumbled across currencies. And I thought, wow, that is interesting. Everything I'd ever focused on was just on us here in the U.S., but there's a whole big world out there, Yep. And I wanted to learn about, how those currencies of the world float around and these big macro events that happen. And so that was really something of huge interest to me. So I went to work for a Forex market maker based out of Manhattan, but in Dallas. Was where I worked, and got an enormous education with that market maker. Also, and speaking of education, went through and became one of the senior people in their education departments. So doing a lot of what Barry does for this Forex market maker, and then from that, it really in working with the retail public, I really could see a knowledge deficit. They saw this new instrument here. They saw the opportunity, but then they lacked the education and the know-how to be able to, really flow and get into this thing and be successful at what they needed. So that's when I started, went into, writing newsletters and things of that sort so that I could educate the public to where they could, read and almost like look over my shoulder, see what I'm thinking, see what I'm hearing, see what I'm doing. And so, it's like a mentoring, really, is the way that I like to look at that. And so it really, helps take somebody along by the hand and helps usher them through this whole process. So that's what I do today.
Well, that's exactly perfect for what we are attempting to do, is to try to bring all of this combined knowledge and experience in diverse different areas and bring it together for you to give you that education. Just a quick note on myself. I'm Bentley Radcliffe, and I'll be your host throughout the whole program, which we've already determined. And I did start also my first job out of school in the financial publishing space, which is where most of you are. And I've tracked it throughout my career, but I specialize in working with specialists, gurus or subject matter experts like these, and helping them draw that wonderful knowledge and experience out into education programs. And so I will be with them all the way through this program. I will be with you all the way through this program. And I am really excited about getting started. So we'll see you real soon. Thank you for joining us. The beginnings of modern currency trading can be traced back to the origins of money itself. A key tenet of foreign exchange theory involves a shared belief that various forms of money, such as commodities, gold, silver, etc., have value and can be readily exchanged for products, services, and other commodities. Currency has a long history of being backed by the value of various commodities, such as precious metals, including silver and gold. But other forms of barter existed as well, such as corn, wheat, salt, and oils as forms of currency, although most often gold was the standard. Gold as a form of currency dates back to the Egyptians in the Eastern Europe between 3000 and 1500 BC, where it became recognized standard of medium exchange for international trade. While gold was an excellent measure of wealth and fortune, it was difficult in raw form to exchange in large quantities and balance the wealth. Some countries amassed large amounts of gold, while others had limited supplies, often due to natural resource or their position of power in the world. In about the 6th century BC, Greece and the Athenian empires started to introduce coinage made from many different metals, but primarily silver. This led to a more balanced system of exchange and encouraged growth of trade and a rapid spread of coinage throughout the world. Fast forward a couple of millennia. The next major change in currency exchange became as representative money, which refers to money that consists of a token or certificate made of paper, legal tender as we call it today. This became very popular during the 19th century, where legal tender, although not standardized, was used for trade. Most of the representative money in the worldwide circulation was backed by stores of gold bullion, a concept first initiated by the government of England. This was a guarantee of pay. Although it did make it easier for trade, it still dealt with a backed currency. As we entered the 20th century, we saw a gradual rescinding of the gold standard. Fiat money was the next step in the evolution of currency. A fiat currency is not backed by the reserves of another commodity, such as gold, but by the value given by the issuing government. This is where we are today. The US dollar, British pound, euro, and others are fiat currencies that make up the primary trading market. Recognition of the United States of America as a global economic superpower meant that the US dollar was almost universally accepted around the world as the world's currency, or the medium for standardized barter and trade. For a period, the US dollar was backed by gold, as representative money would be. But after shipping large quantities of gold to trading partners, the gold reserves of the U.S. were being depleted, and the decision was made to stop this practice. In 1971, the U.S. formally decided that the dollar would no longer be tied to the gold standard, and that the modern foreign exchange market was born. Today, we know the currency market as a floating rate system under which prevailing currency exchange rates fluctuate according to supply and demand of the commodity dollars. Despite all of its problems and volatility, the U.S. dollar continues its dominance by playing a role in an outstanding 70% of all foreign exchange transactions. Hello, I'm Bentley Radcliffe, and it is my pleasure to introduce you to the Roadmap to Currency Riches, a complete Forex mastery course designed to give you an exciting education in the world's largest trading market, but also to greatly enhance your income and your ability to build real wealth. This course is designed both for those who are new to the exciting world of currencies and those who have tried it before but would like to take the next steps needed to really make it work successfully. Even if you have many years of experience, this course will give you refreshing, exciting new ways to approach currencies, aiming for more consistent profits and less risk. Our goal is to build upon your experience and deepen your understanding, sharpen your skills, and illuminate your insights by providing you with everything you need to maximize your chances of success in a vast market that can generate rich profits. The last decade has brought all kinds of turmoil in the markets. The dot-com bust, 9/11, where the stock market actually closed, hyperinflated housing and credit, the oil crisis, and then the credit crisis, the rising unemployment rate, or out-of-control inflation, and a very volatile U.S. dollar. But for currency traders, it has all been great opportunity. For those investors in currencies, rather than getting sucked under the waves of volatility that have roiled the markets, many currency investors have been able to profit from it successfully. Many are profiting from big swings in currency values and an explosion of emerging markets, currencies, and a world economy never experienced before. Business and investors have found the protection from stock market fluctuations through currencies, but until recently, it has not been easy for individuals to do it themselves. To help us with our understanding of the world currency market, otherwise known as Forex or foreign exchange market, and how to profit from it, we have assembled a panel of experts. To my right is Sean Hyman, Kat Von Rohr. To my left is Evaldo Albuquerque and Barry Noble. Welcome, everyone. Thank you for being here with us today. My role in this course is going to be to represent you as a student and ask questions you may have. So let's get right into it. Panel, what are the advantages that each of you see with the currency market? Sean, why don't you provide us with that?
Bentley, the advantages of the currency market are numerous, but the biggest advantage is that it's an eternal bull market.
Can you explain to our audience why that is?
The reason is simple. Currencies are different from stocks, bonds, or commodities in that they let you make money by buying and selling one currency against another. It's like a seesaw. When one is going down, the other has to be rising. So there's always currencies going up. There's always a bull market. Plus, equally important is the fact that currencies reflect global fundamentals and therefore move more independently from stocks and bonds. For the average investor, this means currencies are a great asset class for diversification.
All right, what are the other advantages we know of?
Currencies trend better and more often than other asset classes. This is because traders in the currency markets are led by price action, and price action reflects economic fundamentals. This trending aspect of currencies in the medium and the long term creates excellent opportunities for traders and investors.
I like that no one individual or country can corner the market. Because the world of Forex trading is so large and has so many participants, investors never really have to worry about insider trading or manipulation that could corner the market. But it doesn't really stop them from trying. China regularly manipulates their currency by keeping it within a trading band. Japan does the same thing, and so do some other currencies. Also, central bankers regularly try to manipulate the markets by intervening and buying or selling their own currency against another. But still, it doesn't matter. Central bankers have tried it for years and they never succeed for very long. It's because the world of Forex trading is simply so large and again has so many participants that no outside force can corner this market. Plus, there is maximum price efficiency. It is virtually impossible to manipulate the price of a currency over any significant time frame, whereas investors in the stock market have to worry about insider trading, cooked books, or other corporate shenanigans.
So, Forex traders never have to be apprehensive that there will be an Enron type event in the currency markets.
Another advantage is unsurpassed liquidity. Unlike some thinly traded stocks and other illiquid investments, there's always a buyer and a seller in the currency market.
So it is unlikely you will ever be stuck in a trade.
In fact, of the 3 to 5 trillion traded each day in the currency market, the world's 8 major currencies represent 80% of all trading. In contrast to stocks, bonds, and commodities, it is impossible for all currencies to be crashing all at the same time. Individual currencies can certainly fail and surge against other currencies, but since the depreciation of one currency is automatically linked to the appreciation of another, a crash affecting the entire market is really impossible. If all currencies crashed at once, that would be an entire breakdown of the whole global financial system.
There is a wide range of leverage options, which we're going to explore during later modules of the program. Oh yes, there's one other benefit that Sean didn't mention. It trades 24 hours a day, 6 days a week.
Good point. Let me give you a few other advantages. Number one, you only pay one fee per trade, which is the spread, unlike stock or commodity trades where you may pay up to 3 fees to enter and exit a trade. So technically, FX trades are cheaper than their stock or commodity counterparts. Number two, the FX market is known as the market of last resort because it's the last place that you can go when almost every other asset falls during crashes and recessions, etc.
Let's move on to my next question. So, who trades currencies and why? Barry, what are your thoughts on this one?
Forex is the largest financial market in the world and includes interbank trading or trading between large banks, trading between central banks, currency speculators, multinational corporations, governments, and other financial markets and institutions. Daily turnover in the world's currencies comes from 2 sources. Foreign trade represents 95% of the daily turnover. Companies buy and sell products in foreign countries, plus convert profits from foreign sales into domestic currency. Speculation for profit represents the remaining 5% of the daily turnover.
And now, because of the online Forex trading markets, individuals can both hedge and profit from speculation in the Forex market. We should go over the major currencies that are traded, if that's okay with everyone.
Most traders focus on the biggest, most liquid currency pairs known as the majors. They include the US dollar, Japanese yen, euro, British pound, Swiss franc, Canadian dollar, Australian dollar, and New Zealand dollar. In fact, more than 80% of daily Forex trading happens in those major currency pairs.
The US dollar is the centerpiece of foreign exchange market and is normally considered the base currency for quotes. In the majors, this includes the dollar yen, the dollar Swiss franc, the dollar Canadian. For these currencies and many others, quotes are expressed as a unit of US dollar per the second currency quoted in the pair. For example, a quote of the dollar yen 90.01 means that 1 US dollar is equal to 90.01 Japanese yen.
Got it. When the US dollar is the base unit and a currency quote goes up, it means the dollar has appreciated in value and the other currency has weakened. If the US Japanese yen quote we previously mentioned increases to 113.01, the dollar is stronger because it now buys more yen.
Exceptions to this rule are the British pound, the Australian dollar, the euro, and the New Zealand dollar. In these cases, you might see a quote such as pound USD at 153, but that really means that 1 British pound equals 153 US dollars. And anytime one of these 4 currency pairs is rising, it means that the foreign currency is rising in value while the dollar is dropping in value. For instance, a higher quote for the euro means the euro is getting stronger while the dollar is getting weaker.
I'm sure there are currency pairs that don't involve the US dollar, I assume I'm right, such as if I'm trading or want to know about, say, the euro against the Japanese yen. Sean, you actually have some experience with this thing called cross currencies.
Yes, Bentley, I do. Currency pairs that do not involve the US dollar are called currency crosses or cross currencies, but the premise is the same. For example, a quote of euro yen at 127.95 signifies that 1 euro is equal to 127.95 Japanese yen. When trading Forex, you're trading currency pairs. This means that you're trading 2 currencies at once. Essentially, you're buying one currency and selling another. So when you see a currency pair's quoted price, you're looking at the bid and the ask price. The bid price is the price that you can sell a currency pair, and the ask price is the price at which you can buy that same currency pair. You'll also hear the term PIP mentioned. PIP is an acronym for price interest point. It's just a measure for how a currency pair moves. 1 pip is like saying 1 tick in stocks. It just simply indicates the smallest amount of movement possible.
What are the ways you can trade in the currency market, or the various instruments you can use? Sean?
There are a variety of ways for trading and investing in the currency market. You've got CDs, ETFs, currency options, spot forex, and even futures.
We're going to go into this in greater detail in sections specifically about instruments, but could you give us kind of a quick overview?
Sure. Foreign currency CDs are just like your regular U.S. dollar denominated CDs that you get at any regular bank, only that you are buying and holding foreign currencies in your deposit account instead of U.S. dollars. Investors like them because you have the opportunity to grab a higher yield than most U.S. dollar CDs. Then you've got currency ETFs, and they're just like regular exchange-traded funds, only you're making a direct investment in a foreign currency as opposed to an index, commodity, or other fund. They're perfect for beginning currency investors because you buy a currency ETF with a click of your mouse through your online stockbroker on the NYSE right through your regular stock brokerage account. No special brokerage account is needed, there's no bank account to open, and no physical currency to hold. Currency options are very easy to understand and very easy to trade. In fact, they work just like options on indexes, and they can be bought and sold in your regular brokerage account. Spot forex and futures are definitely for the more active, sophisticated investor, and they offer enormous leverage and profit potential, but also have a high risk. Spot trading is buying one currency with a different currency for immediate delivery rather than for future delivery. There are exceptions, but the standard settlement time frame for a foreign exchange spot trade is 2 days from the date of trade execution.
And futures?
Futures are a way of trading financial instruments, currencies, or commodities for a specific price at a specific date in the future. This is a highly speculative way of trading, and we do not recommend it for the novice investor. It is highly risky.
As I mentioned before, we have specific modules dedicated to each of the trading instruments that will provide you the detail you need on the instrument and the information on how to go about making trades using them. Can you tell me a little bit about margin and leverage? Evaldo, you've not had much chance to speak. What is your thoughts on this?
Leverage trading or trading on margin means you don't have to put up the full value of the position. The money you deposit in a Forex account acts as collateral for your trades. This deposit, called margin, is typically 1% of the value of the position. Forex trading typically offers more leverage than stocks or futures, up to 50 or even 100 times the value of your account. This means that for every dollar you put up, you control $100. In fact, in the spot Forex market, some dealers offer up to 300, 400, and even 500 times leverage.
Of course, higher leverage magnifies both your gains and your losses.
True, very true. My recommendation is that always prudent investors should control their risk. First, learn to trade currency at lower leverage before moving to higher leverage. Second, you should open your account with a dealer that helps protect you from a margin call.
A margin call is a request from a broker or dealer for additional funds or other collateral to guarantee performance on a position that has moved against you.
And as I said before, you should keep your account with a reputable dealer that monitors your account, has a risk management system, and protects you against a negative balance.
That's really great advice. You should write that one down. Okay, let's move on. We hear the term market fundamentals all the time. Can you elaborate on that for us?
There are certain things that are essential for all investors and traders to know. One of these is fundamentals that drive the market and the way to analyze them. Another is technical analysis. Fundamental analysis studies the core underlying elements that influence the economy of a particular currency. It attempts to predict price action and trends by analyzing economic indicators, government policy, and other factors within a business cycle framework.
Would it be okay to offer an analogy?
Absolutely.
You know, if you think of the markets as a big clock, fundamentals are the gears and the springs that move the hands around the face. Anyone can tell you what time it is now, but the fundamentalist knows about the inner workings that move the clock's hands towards times or prices in the future. This is something that all traders need to educate themselves on, and Evaldo and I will spend concentrated time with you to help you educate and improve your consistency and your competency on the fundamentals.
Another term or type of analysis we hear mentioned is technical analysis. Can you please explain a little more what that is?
Technical analysis attempts to evaluate current price action by examining only the price data over a range of time. It is very similar to stocks and uses many of the same kinds of charts, graphs, prediction methodologies, and there are slight variations, so even if you're experienced in technical analysis tools, it will really be a valuable section to review. Most traders use technical analysis to get set up and identify whether there is a high probability trade being presented to the trader. Technical analysts make a few key assumptions. First, all market fundamentals are reflected in price data. Moods, differing opinions, and other market information are reflected in the price. Number two, second, history repeats itself in regular, fairly predictable patterns. These patterns generated by price movements are called signals. A technical analyst's goal is to uncover current market signals by examining past market signals. And third, prices move in trends. Technical analysts believe that fluctuations are not random or unpredictable, but instead, once an up or down or sideways trend has been established, it usually will continue for a period of time.
We will cover technical analysis in greater detail in the technical analysis module. As you progress through this course on your way to making your first currency trade, you need to be asking yourself these questions. What is ideal for you? What are your goals? What is your tolerance for risk? And what size account should you open? How much of your portfolio should you be investing? And how often should you invest or trade? And finally, what instruments are right for you? We want to help you see clearly the type of instruments you should be focusing on, whether that's a CD, an ETF, a currency option, spot forex, or even futures. Our experts will help you through this decision and lead you on your way to making your first trade. As part of these three first modules, you will find a short exercise or set of exercises. We suggest that you practice these after you watch each section. You can find the list of exercises in your companion workbook, plus the answers will be in the back of the book. Is there anything else that you wish to share with the audience before I summarize? In fact, why don't we just go around the table and each of you give me your thoughts on the whole currency market. And let's start with you, Barry.
Oh, thank you very much. But I think that the use of currencies globally is a way of managing your risk, your overall risk. We as Americans think of our wealth as in US dollars, where if we go to Europe or Central and South America, they think of being able to hedge or manage their risk of the currency that they're in. We don't think of the dollars going up and down because many of us don't travel that much. But once we get out of the airport and we start to see the fluctuations every day of how much currency speculates, we think that maybe we won't convert our dollars into pounds or convert our dollars into euro until tomorrow because we see the trend is going. When you look at it and you start to trade and you start to understand it, you can see how much you can take advantage of the world currency.
Yeah, and as large business and banks have been doing for years.
That's right.
So we now have that opportunity, individual investors.
And, individuals as well as small businesses. And there are products out there for them and there are opportunities for them to be able to take advantage of a currency program for maybe the first time ever.
Superb. Thank you for that. Avaldo, you have anything you want to share?
Sure. Just to add to what Barry said, most U.S. investors, they don't look at currency as an asset class, but it is an important asset class to add to your portfolio. That's why 99% of U.S. investors have all their assets in dollars. So investing in other currencies is a good way to diversify a portfolio. When we had the stock market crash in 2008, for example, most asset classes collapsed, but there are many currencies like the dollar and the yen that appreciated against other currencies. So that's just another way to reduce the risk of your portfolio.
Super. So a very large percentage of Americans keep all of their investments in dollars. So this is really a way to kind of expand their horizons a little bit. And at the same time, it's kind of fun because you learn a little bit about the world.
You do.
Thank you. Thank you. Kat, you have something you want to share with us?
Yes. Playing off of what they just said, honestly, what I really like about this market is it is a brand new market. Even though currencies have been free floating and trading for about the last 40 years, really retail investors have only been able to get in there and really invest in currencies from about 1995 on. And as far as long-term solutions are concerned, the time frame has been even shorter. So people just don't understand that this asset class exists. Now, playing off of what you said a bit earlier, you challenged everyone to answer answer a few questions to go into your goals and decide if you're really a long-term or short-term investor. I would say to really think about that and write those goals down right now. If you can do that, then it'll help you as we go through the modules, help you decide whether you're going to be a long-term investor, you're going to look into ETFs or CDs, or you're going to look more into spot or options, and it'll help guide you through the entire course. So I really challenge you to do that.
That's a really great advice to write these types down and actually lay out your goals and your objectives of where you're going in this whole program. I think that's a real nugget to save and to do. And finally, Sean, you've been my support in this the whole time, and you've been great. Well, what are thoughts you might want to share with our students today before we close?
Yeah, just to wrap things up and tie it all together, I would like to just really emphasize that when you start trading, it's almost like riding a bicycle. And when you start riding a bicycle, sure, you're going to fall over sometimes, you're going to skin your knees or what have you. But it doesn't, it shouldn't deter you from the goal of actually riding that bike. And as we all know, as we continue on and just keep plodding forward, we successfully ride that bike despite the few skint knees that we had when we first started. Trading is much the same. When you first start trading, you may not be a pro right out of the gate. Most people are not. You'll probably have a few skint knees here and there, but that's okay. That's called normal, and so you're not doing anything wrong. Just keep doing what you're doing. Keep implementing these principles that we're teaching you, and you will be soaring and riding on that bike very shortly.
In summary, we have covered the following in the introduction: why currency markets exist and how to value a country's economy, who trades in the market, banks, companies, countries, and individual investors, the benchmark currencies that are traded, the currency pairs such as the Aussie-US dollar, and how they fluctuate with respect to one another, the 5 key instruments that you can trade: CDs, ETFs, options, spot forex, or futures, the importance of fundamental and technical analysis, and the initial insight into which instrument might be right for you when you're making your first investment in currency. We hope that you have found this introductory module to be of value and are now ready to continue on the next modules for a deeper dive into each section. We'll see you there. Thank you for being with us.